Welcome back, everybody. Do you remember way back when we used to talk about SCHD all the time?
Pepperidge Farm remembers.
Well, we're back talking about it again because they just announced their changes for 2025. So we're going to break it all down with the help of a cool little tool to understand what's in, what's out, and what it means for what you can expect with SCHD in 2025. Plus, they announced their latest dividend, so we'll take a look at how it compares to last year. Now, let's go ahead and get started. As you may or may not know, SCHD is based off of an index, and that index is the Dow Jones U.S. Dividend 100. And every year, that index goes through a process called Reconstitution, where they go through their methodology and reconstruct the index based on how companies have changed over the past year. Now, since SCHD basically mimics that index in their ETF, it also changes as the index changes. And as of this week, the U.S. Dividend 100 changed, and SCHD has updated to a new list of holdings. So obviously, if you're interested in that stuff, you're like, well, okay, I want to see what changed, and we're going to take a look. Now, normally I would take the old list of holdings and the new list of holdings and load them into a spreadsheet to compare all this stuff. But this year I was like, you know what? Let me ask my friend Claude to do it for me. Now, if you don't know, Claude is the AI chatbot tool from Anthropic, and it's one of the many AI tools that I use. So I was like, hey, Claude, I want to compare the differences in the ETF after its yearly update, and can you show me all these things that I want to see? And Claude responded with building me an actual interactive little website that I could use to check out the changes. So yes, we are living in the future, and let's take a look at what it built for us. Now, I specifically asked Claude for these things. I wanted to see how the sector changes. I wanted to see the stocks that were removed, at least the high-weighted ones, the stocks that were added, again, at least the high-weighted ones, and then stocks that stayed but had their weight change by quite a bit. In addition to that, we have our top 20 holdings comparison and then just some basic key findings. But let's go ahead and start with the allocation changes because I think this is one of the more interesting parts of this. Now, right off the bat, you can see that energy is a big, where the old allocation was a little over 12% and now it's over 20%. So you have over 8% increase in energy stocks in this year's list. In addition to that, you can see that financials dropped by a lot, where it was over 17% last year and now just around 8.5%. And then in terms of the rest, you have consumer staples, which is up a little bit, but then healthcare is down by close to the same percentage. So again, the rest of these end up kind of being more of a wash. And then if we take a look at what stocks were removed, you can see the biggest one is Pfizer, which was 4.29% of the index as of last week, and now is basically gone. Then you have like BlackRock at 3.8%, US Bancorp at around 2.5%, and M&T and Huntington Bank shares. So kind of down the line. Now, obviously, this is one of those things where does this matter? Is this a big deal? I know last year the conversation was around Broadcom because that got taken out of the index. But remember, and we're going to touch on this here in a minute, really this is about the methodology of the index and the ETF and not so much about the individual stocks. But just to continue on, if we look at what stocks were added, you can see that ConocoPhillips was the biggest weighted item added at 4.5%, and that's obviously in the energy sector. You have Merck at 3.9%, Schlumberger NV at 2.29%, Target at around 2%. So you have some different mix of companies here that were added that weren't there before. And then lastly, if we take a look at the weight changes for companies that stayed in the index, really AbbVie is the biggest one, down about 1% based on where it was before. Amgen down a little bit more. But these, the impact really isn't as high as the adds and the removals. All right, so let's take a look at the top 20 holdings comparison. Now, previously, and as of like last Friday, March 21st, you can see that the top 20 holdings, number one, had a total weight of about 72%, and now the top 20 holdings are just under 70%. Now, is that meaningful? Probably not. I mean, again, those things are going to fluctuate as the prices fluctuate throughout the year, so I don't really know that that makes a lot of difference. But if we look at the actual individual holdings, you can see that the top 20 changed quite a bit, with ConocoPhillips now in the top spot when it wasn't even there before. And actually Chevron is now number 2 when previously it was number 4. So you can definitely see how energy really got pushed up to the top, obviously based on the fundamentals and the financials. But it's one of those things where we have to understand what that potentially means in terms of how the ETF is going to perform. And then if we just take a look at the key findings, just some basic stats. The EFT added 20 new stocks with this reconstitution and removed 17. The major sector shifts, which is what we talked about, energy up 8% is pretty crazy. Consumer staples up 3.5%, and financials down around 8.5%. And then the largest additions, removals, and weight reductions are things we've talked about already. So pretty cool stuff, right? I mean, in about 30 seconds, it created this tool that allowed me to interactively look at all the changes, see what stocks were added, were removed, and understand the sector differences so that I have an idea of how the ETFs changed. Now, if you want to play around with this tool yourself, I published it through Claude, and I put the link to it down in the description of the video. You'll get a pop-up that warns you that they're not responsible for what you see on the page, but that's the exact same tool that I used in this video. All right, so all this being said, what should we actually expect from SCHD in 2025? Now, the big changes are energy went up by a lot and financials went down by a lot. And at first glance, I thought this really meant that this would be a little bit more volatility into SCHD maybe than in the past. But when I looked at the actual data, I was a little bit surprised to see that energy has been less volatile than financials over the last couple years. But the thing about energy stocks is that volatility in those stocks goes in phases. And sometimes it can be very volatile just depending on what type of things are happening across the world. So it's just something to be aware of going forward. But ultimately, if you're buying SCHD, while looking at the stocks it holds can be interesting, it really shouldn't matter to you because you're not actually buying stocks. You're buying the methodology that SCHD and the index that it tracks are actually following. And specifically, that methodology is as follows. It starts with the Dow Jones U.S. Broad Stock Market Index, excluding REITs. They have to have a minimum of 10 consecutive years of dividend payments, a float-adjusted market cap of $500 million or more, 3-month average daily trading volume of 2 million, which basically is saying U.S. stocks, excluding REITs that have decent amount of size and good enough liquidity. And then at that point, stocks are ranked by their dividend yield, and only the top half of securities based on yield ranking are eligible for the final selection. And this is where a lot of high quality companies that start to do really well end up falling out of the index because they fall out of the top half of dividend yield. Now, once they have the top half of securities based on dividend yield, they then rank them on 4 fundamental metrics: free cash flow divided by total debt, return on equity, indicated annual dividend yield, and 5-year dividend growth rate. And those 4 measures are equally weighted to create a composite score. And then the 100 highest ranked stocks by composite score are selected into the index, with a couple nuances in terms of if you're already in the index but you're in the top 200, then you remain, and those type of things. And then they're weighted every quarter based on their market cap, and there's some weighting caps and all this other stuff. And I used to go through these methodology PDFs manually and write down line by line what the criteria were. And now I just attach the PDF into Claude and ask it to break it down for me. And honestly, leverage these tools. They are amazing and they can help you get your time back. But let's get back to the point. SCHD is simply an ETF that tracks an index of undervalued dividend-paying stocks in the top half of dividend yield, with obviously some quality and growth criteria sprinkled in. But speaking of paying dividends, SCHD just announced its latest dividend distribution, and it's a whopping 22% higher than the March dividend from last year. And I know at first glance you're like, wait a minute, why does it look lower? But remember that SCHD went through a 3-for-1 stock split, so if you times that by 3, then obviously it's 22% higher. So it's a really nice dividend raise for SCHD holders. And look, SCHD continues to do exactly what it was designed to do. And this is why I always preach really understanding what our goals are and what we're actually invested in. Because a lot of people get introduced to SCHD and sometimes even dividend investing without really understanding, and they get disappointed if it doesn't perform as well as the broader market when times are good. But again, it's not really designed to do that. But it's really great at what it's supposed to do, and that's one of the reasons why it's so popular. Now, is it possible that 2025 continues to be a down year, much like we saw in 2022, and SCHD outperforms a lot of stuff? Well, yeah, it's definitely possible. SCHD is actually up almost 1% this year, while the S&P 500 is down about 1.5%. But here's the thing, it doesn't really matter because you didn't buy SCHD to outperform the market. You bought it to be a strong dividend payer, to have decent capital appreciation, and have good dividend growth. And when it comes to that criteria, it's doing pretty well. Let passive investing be passive. Like, don't worry about these things and the noise on a day-to-day basis. Just focus on how to increase your income so that you can increase your investing contributions over time, and you'll likely do extremely well. It's human nature to get caught up in the financial news every day, and I do it too, but I think with investing a lot of times, less is more, and especially if you're using index funds. So what do you guys think about the changes for SCHD in 2025? Do you have any concerns? Let me know down in the comments. Now, if you want to use the tool that I created in Claude to be able to check out the changes in SCHD, you can do that by clicking this link right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.